Good evening, everyone. Hope you're doing well. As per usual, it's been another fascinating week in financial markets and the global economy. And last night, Federal Reserve Chairman Powell gave his speech at the Jackson Hole conference. And basically, the time has come for policy to adjust, which is a fancy way of saying it's time to cut interest rates. And I wanted to, so Fed Chair Powell laid the groundwork Friday for interest rate cuts ahead, which the market has now priced in a 100% probability of happening in the September meeting. So it's pretty much a done deal, and he's using you know soft language, but the market is smart enough to know what he means there. So what I wanted to point out was this very interesting article on Zero Hedge. So Powell vows to cut rates with stocks, home prices, rent, and food at all-time highs. So they make some very interesting points here, and this is consistent with what I've been saying for the last year or so, that the inflation problem is not solved, that they can't raise interest rates any further due to the massive debt loads, due to the fact that depending on how you want to look at it, the global economy is either in a recession or moving towards recession. And one of the things that happened this week that was quite interesting, and why Chairman Powell talked about the labor market is the labor market is no longer overheated. In other words, unemployment's rising. And one of the interesting things that happened was the Bureau of Labor and Statistics, the Biden Labor Department, they had to admit that they created 818,000 fewer jobs than what they've been saying for the last 12 years. So that's about 65,000 jobs per month. So they've created about 20 or 30% fewer jobs than what they initially reported. So it doesn't sound to me like everything's going well and that things are strong. Uh, so the 4 points that they made here, and it's really the first three that I'm most interested in. So the first point was the Federal Reserve will be ending its tightening cycle. So finishing the ending the cycle of raising interest rates and starting the next easing cycle. An easing cycle is when you cut rates, and they're going to be doing so this will be the first time it's happened with stocks at all-time highs, something that has never before happened in history of capital markets. So if we come across to our charts here and we have a look at the US market on a 1 year chart, you can see, and keep in mind, stocks are prices too, so that's inflation. So that's about 10 months ago in October. Have a look at where the US market is. It's up 35%, and it's recovered almost all the losses from the little freak out we had with Japan blowing up, and they raised interest rates a quarter of a point, and they caused an unwind of that carry trade, which is something that we've talked about a few weeks ago. So stocks back to record highs. So again, why are they why they're cutting interest rates when stocks are at all-time highs? And then the second point is real estate. So this is the first time in history the Fed has finished raising interest rates without home prices falling. So I know a lot of you are probably listening to this in Australia, and you probably just assume that real estate prices always go up. That's not normal. We're in a massive bubble. But this chart here shows national home prices, and maybe we can zoom in on that. National home prices, let me just hide that so we can see. So this was the 2008 crash. So real estate prices dropped nationally for quite a few years. So from about 2008 to about 2012, so about 4 years of decline. And then it wasn't until, geez, what's that, about 2018 or so. So it took 10 years to get back to where they were. Look at where they are now. Have a look at where real estate, they're almost double what they were in the peak of the 2008 real estate bubble. This is American prices in the US. Does this look like the inflation problem solved? I mean, for a lot of people, their biggest expense is either, and we'll have a look at rents. Let's come back to this graph. This is rents. Look at rents, all-time high. Again, why are they cutting interest rates or getting ready to cut interest rates when real estate prices are at all-time highs, rents are at all-time highs, never been this expensive, and the article points out that this is not normal, that you don't normally start cutting interest rates when these things are at all-time record high prices or rent at all-time record high cost. The third thing is food. So this chart would show food prices at home being in America, and away from home. Or sorry, maybe they mean food prices, but food you eat at home and food you buy if you're out and about. But either way, food, CPI, Consumer Price Index for food. Have a look at so that's where prices were in 2008. All right, look at where prices are now as indexed on this particular graph. Food prices at all-time record highs. Does that sound like the inflation problem is solved when food's at all-time highs? And then, of course, the fourth point is they're talking about the money supply, but I won't, for the purpose of this video, I won't delve into that too much. Here's the United States inflation rate. So I've grabbed this chart or this graph, and this is a excuse me, 5 years, and each bar is obviously the inflation data, the inflation read at that particular month. And this red line that I've drawn here, so you can see that's 0% inflation, 2% inflation, 4% inflation. Um, Let me stay zoomed in on that. My apologies. I wanted to get my purple mouse pointer, but I'm not going to get that. Anyway, so the Federal Reserve has an inflation target of 2%. So their mandate, so Jerome Powell, this man here, his mandate is to keep inflation below 2%. So as close to 2% as he can get it, but below. So anything above that red line is bad. That's them failing at their job. And of course, in 2021, inflation started to spike and it got up to 9.1%. It has been coming down. So keep in mind, this isn't inflation coming down. This is what you call disinflation. So prices are still going up 3% on top of how much they've already gone up. So a year ago, inflation got down to 3%. It's now at 2.9%. At no point has it fallen below this red line. Again, does this look like the problem solved? That, is that what you want? Is anyone watching this video thinking that the inflation problem solved, that cost of living is fine, that, you're happy with your prices going up another 2.9% per year on top of how much they've already gone up? Again, this to me shows they're cutting rates very early. And you can see from this graph what a problem inflation has been. Now, if we come across to the US dollar, and this is somewhat related, and keep in mind, I can't give investment advice in this video, but for my clients, what we're doing now is we're concerned that the US dollar is, because again, the market is pricing in interest rate cuts, and we've seen the US dollar come down significantly in the last few months. This is a 1-year chart, and that's the previous low from Christmas last year, or December, or end of December last year. And you can see last night, probably fueled by Powell's speech, saying that they're getting ready to cut the rates. The time has come for policy to adjust. And when policy adjusts, US dollar go down, and it's looking like it's making a fresh low there. But what I would suggest is that, and what I'm advising my clients is that it's bound. If we go to a 5-year chart, so we'll zoom back, you can see that this level around the $100 region, oh, sorry, not $100, it's just 100 on the index. You can see this is a pretty significant price level. We can see a bounce there, bounce, 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 and potentially could bounce from here again. Now, I'm not necessarily predicting that it's going to bounce here, but without being a charting wizard, you would say that the US dollar is probably a quote buy at this level. So what I'm doing for clients is we're allocating probably about 10% of our portfolios to investments that benefit from a rising US dollar. And the reason for that is a strengthening US dollar is generally bad for most other asset classes, for most other investments that we have. So we're concerned that it's going to bounce from here, and that we should be allocating some funds to investments that would benefit from a rising US dollar, because it really can put significant downward pressure on our portfolios if the US dollar is rising. And then it's a chicken or egg scenario, which came first, because you could say, well, is it that the US dollar is rising and that's putting downward pressure on other? And by the way, is it a coincidence that the US dollar, if we go back to this shorter term chart, is it a coincidence that as the US dollar goes for a spill, it's falling? We see stocks hitting all-time highs. We see gold hitting all-time highs. Crypto's pumping. A lot of other areas of the market are pumping. We saw those real estate graphs earlier, although I would say that's not quite residential real estate in the US, probably not quite as correlated with US dollar weakness. But I don't think it's a coincidence that many of those major investments are making highs as the US dollar is making lows. And I'm concerned that it would reverse. But the chicken or egg scenario is, well, is the US dollar rising because it's rising, or is it rising because bad things are happening in the world and markets are rushing to the US dollar? So I haven't done a great job of explaining that, but reach out if you'd like more in-depth analysis of that. If we look at gold, again, if everything's, should they be cutting interest rates when gold is up? So that's October last year. So about 10 or 11 months ago, gold has gone up 38%. And you can see it's very close. It didn't quite close at an all-time record high, but super, super close to an all-time high. Again, if everything's fine, if the inflation problem's solved, if interest rates are sufficiently high at the moment, why are stocks making record highs? Why is gold at record highs? Why is real estate, food prices record highs? This is not consistent with the inflation problem being solved. Gold is a price too. Stocks are a price. Look at the Australian market. Remember we had the Japanese, a couple of weeks ago, there was a bit of a freak out over what was happening in Japan. Sharp sell off. Look at that. Almost all the losses have been recovered now. Remember at the time, 3 weeks ago, all the gurus were out there saying, this is it, the crash is here, get out, everything's going to crash. And as soon as they said that, up goes the market. And we've looked at the US market earlier at an all-time high because the market is now pricing in interest rate cuts. We're seeing US bond price. So this is a fund that owns 20 and 30-year US government debt. Found a bottom in April, and it's gone up about 12% since then. So for those of you who have been invested in bonds, or there was an opportunity to trade bonds to make some capital growth there. And if we come across to bond yields, so if we look at interest rates in the market, if we have a look at the interest rate on 1-year US government bonds, keeping in mind the Federal Reserve has interest rates set at 5.25% to 5.5%. They operate in a band, but the interest rate on a 1-year government bond is 4.39%. So it's about 1% below where the Federal Reserve currently has interest rates. So that's the market telling you that over the next year, they expect the Federal Reserve to cut interest rates by at least 1%. So 4 rate cuts. And if we go out to the 10-year bond, which is the interest rate on 10-year US government bonds, which is a very key rate, it's trading at 3.8%. So it's about 1.5% below where short-term interest rates have been set by the central bank, by the Federal Reserve. And you can see at the end of 2023, interest rates went on a bit of a run as the market thought, oh well, they can't cut rates yet. Or lots of reasons, I guess, why bonds were falling in price and yields were going up. But you can see uptrend, and then the trend breaks, return to the scene of the crime, return to the scene of crime again, and then spill. And if we take the previous low there, it's looking like it's broken down. It's trying to recover. This is pretty bearish action. This is likely going to trend lower over the medium term. Keeping in mind, if you're a client of mine, one of our biggest positions is in global bonds. So when interest rates are coming down, so if this is happening, that means the price of our bonds are going up. So as this comes down, we're making a nice return. If interest rates go up, we're losing money. Our investment is falling in price. And if interest rates are coming down, bond prices are going up. So this is looking quite positive. And if we come across to interest rates in Australia, if we look at the interest rate on Australian government bonds, the 10-year bond, we can see pretty similar to the US. Found a bottom around Christmas last year, and you can see it was in an uptrend. And it's, I show this stuff all the time. It's the charts can be very effective. You can see lots of touches there on support, and then eventually quick breakdown, recover, return to the scene of the crime to test the breakdown, and now it's right down on the lows again. And you could argue that this one is breaking down as well. I mean, that low is not holding. It's starting to trade below that low, that previous low. Again, if interest rates are going down, bond prices are going up. So that's somewhat positive for our strategy. But keeping in mind, I cannot give investment advice in this video, educational purposes only. But if you'd like to reach out and learn more about what my clients and I, or if you're a client watching this and you want to talk about your portfolio, how this relates to your investments, please do reach out. I might leave it at that for today. So the key theme is that we seem to be at a turning point. The last 3 to 6 months, we've seen the Europeans cut. So the European Central Bank has cut rates. The Bank of England has cut rates. New Zealand has cut interest rates. I think the Central Bank of Sweden and Switzerland have both cut rates, or definitely Sweden cut rates the other day. So it seems like they're all working in concert now. All the central banks, the time has come for policy to adjust. They're patting themselves on the back. They're not worried about inflation anymore. Now they're going to cut rates. And as I've shown on this chart and in many other videos and methods of analysis, I think that they're cutting interest rates too soon. And we've looked in other videos at the real reason why I think they're cutting interest rates. So anyway, thank you for listening. Please reach out if you'd like to discuss in more detail, and enjoy the rest of your weekend or your week, depending on when you're watching this. Cheers.